Hello and welcome to Market Domination Overtime. Stocks closing mostly lower here after initially rising on that January inflation print. And our very own Jared Blickery has all the headlines. Jared.
Thank you, Josh. Pretty low volatility today, and we are looking at some losses for the week. I'll show you the 5-day totals here. Here's the Dow, actually closed up almost 50 points today. Not a huge amount, but for the week, we are down 1.23%. Here's the NASDAQ down fractionally on the day, down 2%. For all the heavy tech selling we saw in software earlier, could have been a lot worse. And the S&P 500 barely closed in the green, down about 1.4% for the week. And I do like to get a look of the Russell 2000, the small caps underwater for the week, down 1%, although they were up 1% today. And taking a look at the large cap sector action, it was a story of utilities. And I got to show you utilities closed at the first record high. This is a one-year chart since October of last year. First record high since October of last year. Also had consumer staples closing at a record high. That is right here. I'm circling that. But one of the other leaders was real estate. The other was healthcare. So a lot of defensive action towards the top. What didn't work today, communication services and financials. And if we take a look at the 5-day totals, it was the same leadership that we saw today. Utilities and real estate in that order, 7 and 3.5% respectively. Then we got materials and energy staples, industrials, and rounding out the bottom here, we got financials and consumer discretionary underperforming the S&P 500. I'm going to take this back to a day look, and here's what happened in the NASDAQ 100. A lot of negative action in the mega caps. Tesla just barely green there. I'm circling that to the downside or at the bottom of the heat map. Walmart also up, and we had some outsized outperformers in the chip stocks. Applied Materials up 8%, although you can see there's a lot of red, especially in some of the bigger names on this board. Yet in software, which had kind of a lousy week, kind of a lousy year, pretty good today, excluding Microsoft, which is taking up a lot of real estate. So I'll change this to an equal weighted view, and you can see on the top line, everything up from 7 to 3%, including Teladoc, CrowdStrike, Snowflake, and a few others, HubSpot as well. So let's finish here on the Dow, and aside from the mega caps that we covered, looks like Visa ending the day down 3%, United Health was up 3%, Nike up 3%, Disney right there with it, and Salesforce coming back, that was up 2%. Caterpillar, the industrial name, the leader of the Dow over the last year, that also closed in the green for about 2%, Josh.
All right, thank you, Jared. Well, it's been a busy week for economic data, getting both CPI and the jobs report. And my next guest says on the labor front, the economy is just starting to find its footing. Join me now, we got Nicole Bichot, ZipRecruiter labor economist. Nicole, it is good to see you. So let's dig into what you're seeing, Nicole, on that ZipRecruiter platform, because you all have such unique line of sight into the labor market in terms of job postings and employer behavior. One trend you point out here, Nicole, you say jobs are landing faster, but you say expectations are lower. What do you mean by that? Walk me through that trend.
Yeah, we've seen workers really finding their footing and finding roles that fit their skill sets better. So in our recent survey of new hires, we found that the majority, over 50% of new hires, are finding their job within a month. But we're seeing fewer people end up in a quote unquote dream job positioning. So while we're seeing workers kind of moving quicker, they're focusing more on what's realistic versus holding out for maybe what's more idealistic for them, given the challenges in the market right now.
Interesting. What are you seeing, Nicole, in terms of pay pressure, incentives?
So pay has been actually really interesting. We just got the January BLS data earlier this week, and there's still strong pay growth, up 3.7% annually in January, which is still good news given the drop in CPI, as we've seen wages kind of outpacing inflation for the past 2 to 3 years. That is really helpful for workers to kind of maintain their footing and find some sort of negotiating power within their positioning. Definitely a good news for the continued budgetary pressures that a lot of households are facing right now, that we're still seeing some elevation in wage growth.
I always think it's interesting, Nicole, to get your take. When the new hires get that offer, all right, now it's time to negotiate, right? What are you seeing there in terms of trends?
So negotiating is a really, really important strategy for workers as they're looking at different offers and trying to figure out what to accept. Fewer people are negotiating in this market, likely just driven by the challenge of getting to the offer stage in the first place. But the majority of those who do negotiate get a better outcome, whether that's an increased base salary or better benefits. So negotiating is still a really powerful tool that workers and new hires are still applying, just at a little bit of a lower rate, given a lot of the turmoil and the challenge to finding a job.
We used to talk about the Great Resignation, Nicole. You remember that. But I looked at your data, and I just wonder, are we seeing that shift there? Because your data would seem to suggest, okay, it's kind of like what people are prioritizing is more stability over job hunting.
Absolutely. I'm actually working on a new survey right now that looks at the entire US workforce, and we're seeing this very strong positioning of stability. The majority of workers claim to be staying in place due to economic conditions, whether that means delaying a job search or staying in their job and not moving somewhere else, due to the stability of the paycheck they know and they have now versus going out and trying to find something else. So stability is really top of mind for workers and employers. But when we look to the new BLS numbers that we got for January, there are some signs that the market might become a little bit more unstuck as we go into the spring of 2026, with job growth up and unemployment falling.
Yeah, in that jobs report that we got, Nicole, I wanted to dig into some of the sector strength, and particularly the strength we saw in healthcare, which got a lot of headlines. Any ideas, Nicole, of what explains that, and whether you thought you looked at that and said, okay, that's cyclical, or no, that there's something structural there?
Absolutely. The structural versus cyclical difference is exactly what's going on with healthcare compared to other industries. There is always an outsized demand for healthcare jobs when we look at the labor economy as a whole. But given the kind of slowdown we've seen in some other macro factors that are leading to, drops in manufacturing and tech and, business services over the last year, healthcare has really become more of a spotlight given the strong demand. The US population is aging very significantly. Over the past 20 years, the share of the population that's 65 plus is quite larger, a lot larger than it was a couple of decades ago. And as we see an aging population, there's going to be more demand for healthcare jobs. And so the demand for healthcare is driven by demographic trends, not so much by the cyclical economic movements that are going to move other industries.
Construction also looked to be holding up, and I was curious to get your take on why that would be. The sort of the relative strength, Nicole, you see in skilled trades. Is that higher wages? Is that the big data center build out we keep talking about?
A lot of it is also going to come back to that demographic factor. As we see older people aging in place and we see younger folks getting into their prime home buying years, there's a lot of demand for growth in housing that saw a big dip for about 15 years following the Great Recession. So there's a lot of demand for home construction, which is driving up, labor growth and job growth in the construction sector, as well as, growth in other industries, like you mentioned with AI data centers. That'll be kind of more localized to certain economies. But there's absolutely a really strong push for skilled trades right now.
We did see this temporary staffing jobs rising. I'm curious what that tells us. Do you look at that as an economist? Is that any kind of like leading indicator, Nicole?
Yeah, temporary staffing can be a leading indicator of kind of where businesses are looking ahead to. As we see a rise in temporary staffing, like we have for the past couple of months, job growth in that area can signal that employers are looking to ramp back up slowly without committing to full-time hires at this point. And so that can really show us what the next steps and the logic behind the hiring decisions for businesses, where that's sitting right now. And as we see that continue to increase, that is an indicator that we could see, continued growth in jobs overall in the coming months.
And finally, Nicole, you did highlight here how the unemployment rate for Black workers and teens improved. What do you make of those trends?
So much like staffing services is a leading indicator, Black unemployment rate is a leading indicator for the market health overall. We saw a pretty big drop, a 0.3 percentage points drop in Black unemployment, which is a good signal for unemployment overall, which also ticked down slightly, that we will see hopefully more stabilization and a little bit better recovery. And like you said at the start of this call, the labor market that's really finding its footing as we're seeing these rates falling for these different populations.
Nicole, as always, great to have you on the show. Enjoy the weekend.
You too. Thanks, Josh.
Coming up, we get a read on the outlook for crypto regulation. That's next on Market Domination Overtime. Despite Bitcoin's turbulent run, some remain steadfast in their belief in the cryptocurrency, especially if the Clarity Act gets passed. Yahoo Finance's executive editor Brian Sozzi talked through the latest in the crypto bill with Patrick Witt, executive director of the President's Council of Advisors for Digital Assets.
So the status right now, the House passed the Clarity Act, their version of it last year, over to the House in July, I believe. And the Senate has taken it up and made its own changes to it and is fashioning their own version. We were able to pass half of the bill out of the Ag Committee that handles the CFTC portions. And now we're just stuck in the Banking Committee for the SEC portions, the securities portions of that bill. So there was a markup that was scheduled on, I believe, January 18th that unfortunately got pulled down, postponed. But we're working hard to address the issues that were raised that led to the postponement of that markup and hopefully get that back on the books soon. And then once we pass that out of the Banking Committee, the two pieces of the legislation will need to be reconciled before a final vote on the floor. So more work to be done, but we're a step closer with the passage of the ag portion of this a couple weeks ago.
Patrick, who has to bend a little bit ultimately to get this over the finish line? Is it the crypto community or the banking community?
Not to be cliche, it's a little bit of both, and we've encouraged both parties. We've had conversations individually. We've hosted a number of meetings here at the White House. We might host another one again next week on this issue of stablecoin rewards and yield. And it's unfortunate that this has become such a big issue because ultimately this is not the stablecoin bill. That was the Genius Act. But we've heard from senators on both sides of the aisle concerns about potential deposit flight from stablecoins on different platforms. And so what we've encouraged both sides to do is let's find a middle ground. Let's use a scalpel heel here to address this narrow issue of idle yield, let's call it. But let's not take a chainsaw to this. Let's not let this derail the bill. There is so much goodness in this bill, no matter what your perspective is. The banks, there's a lot of permissible activities. It allows these institutions to now play in the crypto space in a way that without that regulatory clarity, they wouldn't be able to. And then obviously from the crypto side, the regulatory jurisdiction, the clear lines between the SEC, the CFTC, developer protections in the bill. There's just a litany of excellent measures in here that are critical to future-proof this industry from a future Gary Gensler or, God forbid, a Secretary of the Treasury, Elizabeth Warren. So we want to make sure that people are approaching this the right way, that they recognize the value of this bill. And we're going to keep working to make it better, but ultimately it is a good product at the end of the day.
In the spirit of compromise, Patrick, do you think the crypto industry just has to get off this view that it's going to be able to pay rewards on stable coins? Does that get it through?
Again, as I said, there's a way to address this that doesn't disrupt a lot of the business models in the space and also addresses the bank concerns. So this is a major item. It's not the only one. There's still some issues on Title I with tokenization, the token taxonomy, and the authorities between the SEC and the CFTC, making sure that the SEC isn't swallowing too much of the CFTC's jurisdiction. And then on Title III with DeFi, illicit finance. So there are other issues that we need to work through. But this is a main sticking item, and we're not going to be able to get this out of the Banking Committee unless we address this issue. So that's why we've taken it so seriously, why we've hosted the different interested stakeholders here at the White House, and we're going to continue to stay at the table and encourage them to find a compromise on this issue because it really is the major gating item.
We'd love to get your take on this one. When I talk to banking executives on this particular issue, they say that community banks just might struggle to lend to businesses if these crypto players are allowed to pay these rewards. I mean, do you share those concerns?
There's been a number of studies that have pointed in either direction. I think ultimately our bottom line is consumers win when there's choice. But we've heard from a number of senators And again, it's bipartisan on this issue that they want to make sure that the concerns of the community banks are addressed, that we're not doing anything that would cause deposit flight from their platforms. They are important pillars of the various communities around the country. And so I think we can do that. I think we're fashioning a compromise. Last week's meeting between the banks and the crypto companies, I think, broke some new ground, established some new common ground, some areas of agreement, and we'll build upon that. But whether or not we agree with that view, I think I've seen studies that point in either direction. Ultimately, there's going to be a convergence between crypto and the banks. Right now, it is a new product. It's somewhat threatening to the community banks and not just the community banks, but also the GSIBs, the larger banks. But they're ultimately going to start getting into the crypto space. They can also offer stablecoin products to their customers, just the same as crypto. This is not an unfair advantage in either way. And then many of the banks are now applying for OCC bank charters themselves to start offering bank-like products to their customers. So in the future, I don't think this is going to be an issue, but we're managing through an interim period where there's a lot of people on the bank side of the table that feel threatened by this, but ultimately I think they're going to find opportunities to use these products and leverage them and offer new products to their customers and expand their businesses.
Should a Jamie Dimon at JP Morgan be threatened?
I don't think so. I think there's tremendous opportunity for the JP Morgans of the world to engage in crypto activities. If you just go to LinkedIn, there's plenty of job postings at JP Morgan hiring people into the digital asset space. So I think they're indicating that they intend to get into this space in a big way. They were present at last week's meeting, very constructive, and I think. Yeah, on the stablecoin part of this, there's the consumer banking side, but then there's also the institutional bank side. And as more and more liquidity gets added to treasury markets, with stablecoin being backed by T-bills, there's a lot of activity and commercial activity that the larger banks that have rates trading operations can get into. So I think for those larger banks that have those kinds of business lines and large practices there, they recognize what an opportunity this is.
Brian Armstrong over Coinbase. He sounded a little more optimistic, Patrick, last night on his earnings call about clarity getting passed, at least compared to what we heard from him at Davos in January. Do you think this ultimately gets passed in the first quarter, or is this more mid-year?
We're definitely on the clock. There's a window here. The window is still open, but it is rapidly closing. And so that's why we are taking it so seriously, why we're encouraging folks to cut the deals that they can, to stay at the table. Let's not let any moss grow here. We got to get this done because, as I mentioned, it's one step in the process. If we can get this out of the banking committee, it still needs to be reconciled with the ag portion. And ultimately, there's going to be a cloture vote and a passage on the floor. That all takes time. And the most precious real estate in Washington, D.C. is Senate floor time. So we're in regular touch with Leader Thune about that. But he knows that this is a priority for the president, priority for my boss, David Sachs. And I do believe we're going to get this done. I won't necessarily put a date on it, but before the midterms really start to take all the oxygen out of the room, we have people engaged at the table that have invested countless hours on this bill, and we're going to get it done.
Lastly, Patrick, you're in the trenches on the Bitcoin reserve that is being built out here in the country. Where does that stand?
So with the passage of the executive order, what we wanted to do with that is get an accounting of what the government held and then also stop the bleeding. So stop these agencies from willy-nilly liquidating digital assets that they had, sometimes at fire sale prices. I think by some estimates, based on the sales and the way that they were conducted under the previous administration, we the government, may have lost out on tens of billions of dollars that could have been held on our balance sheet. So right now we've stopped the bleeding. We're in regular touch with the agencies, monitoring the current status of the digital assets that they hold, making sure that the accounting is complete, not just Bitcoin, but obviously many of the wallets hold different digital assets in there that need to be appropriately accounted for. And then on the Hill, there's the Bitcoin Act that Senator Lummis had introduced. There's going to be a new bill introduced by Representative Begich in the House that builds upon that and allows some of the necessary authorities to centralize, properly safeguard these assets, and then explore budget-neutral ways to add to that stockpile. And then in the future, ultimately, if Congress decides to move in that direction, to allow for us to potentially add to that with outright purchases. But that would need to be an appropriations decision.
Time now for what to watch. A quick bit of housekeeping. All major U.S. markets, remember, are closed Monday in observance of President's Day. It's been another huge week of earnings, though. Palo Alto Networks, Toll Brothers, DoorDash, and Klarna, they're all among the big names set to report. But investors, we know, they'll be focused on a newly minted trillion-dollar company. That would be Walmart in its fourth quarter earnings on Thursday. Analysts expecting the retail juggernaut to deliver a solid holiday quarter with net sales rising roughly 4% and operating income climbing as much as 11%. Strong pricing and digital momentum are also expected to drive results, while businesses like advertising could help support gross margins. Investors will be listening closely, of course, for any commentary on the health of the consumer and 2026 guidance. On Wednesday, we got the minutes from the January FOMC meeting, offering more insight into how policymakers are thinking about the path of rates after holding steady to start the year. And to finish the week, the Fed's preferred inflation gauge is coming out on Friday. That is personal consumption expenditures. That coming after Friday's cooler than expected CPI print, showing prices rising 2.4% year over year. This is the lowest since May. Now the question is whether PCE confirms that inflation is steadily cooling or gives the Fed reason to stay cautious. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back Tuesday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, we have our special Bought and Sold, investing in robotics. We break down everything you need to know about the robotics industry, from investment ideas to Tesla's future with Optimus. Stay tuned.